Hello, I'm Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about money management for single parents. Now, as a single parent, you're probably familiar with the dual challenges of managing a household and planning for the future. But are you as familiar with the financial strategies that can stretch your income and help you get ahead? Consider the following lessons to help improve your family's bottom line. Lesson number one, identify your goals. Pretty basic, right? You can't have a financial plan without first defining your financial goals. Start by recording all your short, medium, and long-term goals. For example, paying for your child's education could be one of the biggest expenses in your future. During the 2016 and 2017 school year, the average total cost of 1 year in private college was $45,370. Now, I got to tell you, I think it's a lot higher than that right now. And at the same time, during that time, the average public college was about $20,090. Now, according to the College Board, if expenses continue to rise at their current rate, a college education could exceed over $550,000 for a private college, or as much as $250,000 for a public college in the next 18 years. That's a lot of money. It's a big goal, right? It becomes a big goal. Let's talk about the next goal. Retirement is another important goal. Most financial planners suggest accumulating enough of a nest egg so that when combined with Social Security and any pension payments that you may be able to receive, it will likely provide at least 80% of your final working year salary during each year of retirement. Now, most of us are not going to be eligible for a pension payment, so we would have to make up that difference with Social Security just with our savings. So that could be a big thing that we would have to plan for. And this may be something you definitely want to speak to a financial planner about to help you determine what that amount might be for you. Let's look at lesson number two, be a better budgeter. To pursue your family's goals, it's necessary to manage your household's cash flow. Now, that involves tracking income and spending, eliminating unnecessary costs, and living within confines of a realistic budget. For example, if you spend $1.50 every day on takeout coffee, that amount adds up to about $45 a month. By eliminating that minor expense from your budget, you could easily save an additional $500 a year. Most likely, if you're buying coffee out, it may actually cost more than $1.50 a day. So that number could be a little bit higher. Lesson number three, say no to debt. High interest credit card debt can make it extremely difficult to get your budget in order. If you have an outstanding balance, consider paying it off as aggressively as possible. The savings and interest alone could allow you to address other important goals. Now consider this. The average credit card balance of the United States adults is about $5,540. Now, interest rates typically average over 12%. So if you made only the minimum monthly payments on a debt at 12% annual percentage rate, it could take years to pay it off, and you would spend thousands of interest in the process. Now, if you want to check that out, you can go back to creditcards.com. There's some credit card statistics there that may provide a little bit more information about that. It's also a good idea to review your credit history. You want to make sure that the information it contains about your past use of credit is accurate. You want to make sure it's your name, your credit. Lesson number four, learn about savings and investment opportunities. Now, once you free up some cash, you want to apply it towards your goals. But first, you want to learn about the savings and investment opportunities available to you. Keep in mind that tax-deferred investment accounts may enable you to grow the value of your assets more significantly than your taxable accounts. Now, that's because investment gains in taxable accounts are taxed every single year, while those in tax-deferred accounts remain untaxed until you make withdrawals later in life. Now, employer-sponsored plans, such as traditional 401k plans, allows you to set aside a portion of your pre-tax income in a company-sponsored plan, which would be a tax-deferred retirement account. As an added benefit, some employers make a matching contribution to the employee's account each time an employee makes a contribution. Now, there may be some limitations there. You just definitely want to check with your retirement plan document to see what they would be. Now, traditional and individual retirement accounts, also known as IRAs, may allow you to deduct a portion of your annual contributions from your taxes. Now, that obviously depends on your income, but they also offer tax-deferred investment growth. There's also a Roth IRA. Now, Roth IRAs do not offer a tax break for contributions, but investment earnings are untaxed and qualified withdrawals are tax-free, assuming you follow all the rules that go along with the Roth IRAs. Now, you also have Coverdell Education Savings Accounts. They're formerly known as Education IRAs. They allow tax-free earnings on non-deductible contributions up to $2,000 annually. Now, those qualified withdrawals may be used to pay for college as well as some elementary and secondary schooling. There's also the option of 529 College Savings Plan. Now, they're state-sponsored investment programs, and they allow tax-free withdrawals for college expenses. College savers who contribute to their home state's 529 plans may also be eligible for state tax breaks. If your state or your designated beneficiary state offers a 529 plan, you may want to consider what, if any, potential state income tax or other benefits it offers before investing. Now, once you've selected an appropriate investment account, you'll then need to determine an appropriate investment strategy. Now, in general, stocks have the most short-term risk, but they also have the potential to generate better long-term returns than money market or bond instruments. Therefore, the longer your investment time frame, the more you may want to rely on stock investments to pursue your financial objectives. Let's move on to lesson number 5, get professional advice. That's a favorite of mine, right? A financial professional can suggest specific strategies for you and also point out any considerations you may have overlooked, such as insurance, estate planning, or tax. Also, make sure you ask how much the professional charges for his or her services. Now, remember, successfully managing the finances of a one-parent household takes time and dedication. But once you begin to see an improvement in your family's bottom line, you'll know it's worth the effort. I want to thank you for joining us today. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. Our website is forgewealth.com, and you can follow me on Facebook, Twitter, and YouTube at Forge Wealth, and on LinkedIn, I'm Regina McCann-Hess. Have a great day.